revision program will cover the following topics, and these are all the topics that you have dealt with in term 2. We're going to look at demand and supply, market equilibrium, production possibility curves, price ceilings, price floors, minimum wages, and then we will end off with the perfect and the imperfect markets. Activity 1. Use the information presented in the table to do the following. Construct a demand and supply curve on the same set of axes, and on the graph indicate the market equilibrium. And there they've given us the price in rands. It ranges from 1,000 Rand to 6,000 Rand. And there we've got our demand schedule and our supply schedule as well. So we need to now take this information and put it onto a graph. Now you need to remember that when you're drawing a graph, you have your two axes, you have your horizontal and your vertical axes. Obviously your horizontal axis will be the price, and your vertical axis will be the price, and your horizontal axis will be your demand and supply that you're going to show. So let's have a look at what that looks like. So there we have our price and we have our quantity. And there we have our rands going from 1,000 to 6,000. And then we plotted the curves, plotted the different points, and this is the shape that we were given. Right, so from this graph, what can we now get from this graph? So the first thing we see from the graph, if we look at our demand curve here, right? What do we notice there? We see that at 1,000 Rand, there are 9 units being demanded. At 3,000 Rand, there's 6 units being demanded. And at 6,000 Rand, there's about 4 units being demanded. So we see the demand has gone down from 9 units to 4 units as the price has increased. So what does this tell us? That less is demanded at high prices and more at low prices. And that's exactly what the law of demand says, right? More demanded at low prices and less at high prices. If we look at the supply curve, on the other hand, we see that at 1,000 Rand, there are 3 units being supplied, whereas at about 6,000 Rand, we have about 9 units being supplied. And here we have at 3,000, we also have 6 units being supplied. So what we notice here is opposite to what's happening with the demand. Remember, the law of demand says less is demanded at high prices and more at low prices. And with supply, we see the opposite happens. There is more being supplied at high prices and less being supplied at low prices. Okay, so we can see there your law of demand and law of supply are opposite to one another. Also, when it comes to the law of demand, we say that there is an inverse relationship between the price and the quantity being demanded, meaning that as the prices increase, the demand decreases. Okay, and that gives us that what we call the negative slope of the demand curve, results from that inverse relationship. Whereas with supply, we see that as the price increases, the quantity supply also goes up, so that gives us the positive slope of the supply curve. And the point where the two meet, that point there is known as market equilibrium. So where supply and demand is equal, that is when we then get equilibrium. And therefore, our equilibrium price on this graph would be 3,000 Rand. And at 3,000 Rand, the equilibrium quantity that's being demanded and supplied is 6. Okay, just to recap again, demand has a negative gradient, supply has a positive gradient. When prices are high, demand is low. When prices are low, demand is high. With supply, when prices are high, supply is high. And when the price is low, the supply is low as well. Right, now we're moving on to activity 2, and here we're looking at some multiple choice questions based on demand and supply. So choose the correct answer from the alternatives given. Write only the correct letter next to the number. For example, 2.1D. There'll always be 4 options given to you. If you recall, when we did the revision for paper 1, I explained to you the layout of the paper. It's exactly the same with your microeconomics as it was with macroeconomics. When it comes to multiple choice questions, always 4 options given. Right, and in the same way, we also read the statement carefully and know what it is saying. Think what your answer would be and then look for your answer in the alternatives that are given. So the question says, or the statement says, which of the following will not cause a shift of either demand or supply curves? So if you remember, we did a section on the shift of the curves and the shift along the curves, right? Now, we said to you that when we look at a shift along the curve, that only occurs when there's been a change in price. Everything else causes the entire curve to shift. So it is only in the case when there's a price change that there's a shift along the curve, meaning the demand curve or the supply curve doesn't go anywhere, the shift happens along the curve. So let's see what our options are. A, it says changes in the taste and preference of consumers. I just said there's nothing to do with price, so therefore that's going to cause a shift of the curve. Changes in the price of substitute goods. Right? It is not the change in the price of the goods we are looking at. It is the substitute goods, meaning substitute goods are goods that can replace other goods. Then we've also got changes in the price of a good. So that's a possible answer. And then D says change in price of complementary products. Now, complementary products are goods that are used in conjunction with each other. For example, toothbrush and toothpaste. So the only answer we can get here from all of these given is C, right? So that would be your answer for 2.1. 2.2, what is meant by the equilibrium price in the market for a good? We've just had this in the slide before this. I just explained to you now. Equilibrium is formed at the point where demand is equal to supply. So here they give us the options are A, the average price paid by consumers, B, the price at which maximum profit is made, C, the price at which the producer breaks even, or D, the price at which the supply and demand curves meet. So out of these 4, our only correct answer we can come up with here is D, right? Right, 2.3. The diagram shows a shift in the supply curve for cars from S1 to S2. So there we have S1, and we see that the supply curve has moved to the left, right? So it has moved from S1 to S2, and now once again, when the demand or the supply curves move to the left, what does that mean? So we need to look at that now again. So if your supply curve or your demand curve moves to the left, as you can see from here, your quantity has decreased, right? So there's been a decrease in the supply from S1 to S2. So now we understand that there's been a decrease in supply, and now the question is, what is the most likely cause of this shift in the supply curve? So what they're actually asking you is, what would cause the supply to decrease? Would it be an increase in an indirect tax on petrol? Would it be an increase in the price of cars? An increase in the wages of car workers? Or a new subsidy given to car manufacturers? Now you've got to think about this very carefully. Which one are you going to choose here? Right. First off, you can already see D is definitely not, because subsidies, when a business gets a subsidy, which is the point D here that they're talking about, a new subsidy. So when that happens, it means that the supply can actually increase. But in this case, we see there's a supply decrease. So it's definitely not a D. Right. With an increase in the price of cars, we just saw now that as the prices increase, and from here we can also see that as prices increase, the supply also increases. And so the price would be a shift along the curve, right? So this is a shift of the curve. The increase in an indirect tax on petrol is not going to affect my supply at all. So the only answer we can get from this is C, an increase in the wages of car workers. Because remember, one of your biggest expenses that any business has is that of wages and salaries. So therefore, it's costing them more to make it when the wages of the workers go up, and therefore they then supply less because their costs have increased. Right, 2.4, once again, the diagram shows the demand curve for coffee. So let's see what has happened here. We see at price P1, Q1 is being demanded, and then at P2, Q2 is being demanded. So what we notice here is that there's been a shift along the demand curve. And once again, we said the only instance when there's a shift along the curve is when there is a change in the price, right? So let's see here. A, coffee is cheaper. B, incomes increased. C, there was a successful advertising campaign. Or D, the price of substitutes for coffee increased. Right? So out of the 4 options given, the only possible answer here would be A. Coffee has become cheaper, meaning the price of coffee has dropped from P1 to P2, and therefore the demand went from Q1 to Q2. Sorry, that was letter A, right? Then 2.5, what is the basic economic problem? So what do we really work with when we think of economics? And this was taught to you under macroeconomics, but I want to show you how your macroeconomics influences your microeconomics. That's why I put this question in here. So is it the fact that we have excess, meaning there's extra? Is it because of a depression, a recession, or scarcity? And if you think back to your definition of economics, we said economics is the study of how people use their scarce resources to satisfy their unlimited needs and wants. So the problem of economics is around the issue of scarcity, right? So that would be D. Why do consumers have to make choices when spending their income? We just said now that they have scarce resources, so their income is limited, so therefore they've got to decide what it is that they need to buy, what is more important. So advertising compels them to spend, consumers have excess income, consumer cannot satisfy all wants with their income, or not all products are attractive to consumers. Okay, right. So out of these 4 given, right, advertising does send people to go and buy, right? Sometimes people have a little bit of extra income and they can spend a little more, not all the time though. And yes, it is true that not all products are attractive to consumers, but that's not the reason why we have to make choices. The reason we have to make choices is because consumers cannot satisfy all wants with their income, right? Our income is limited and our wants are unlimited. Right, and there are the solutions given. Okay, so this brings us to the next section. So many believe that in economics they are going to learn about investments and how to make money. And I'm sure by now you've realized that's not what you're learning in economics, right? But in essence, economics looks at how we use our scarce resources to satisfy our unlimited needs and wants. So the best thing we learn from economics is how to make better choices. And as almost all things in economics, this can be explained by using a graph. And obviously the graph that I'm referring to here is known as the production possibility curve, or the PPC. There are some textbooks who will also talk about a PPF, the production possibility frontier. Now with your production possibility curve, I need you to note you've got goods A on the one hand and goods B on the other hand. This could be mountain bikes and tricycles, or robots and forks, or whatever your combination of goods are, right? So what we mean with a production possibility curve is we have the possibilities that can happen, and then along the curve, right, is where you can be producing, right? Because anywhere along this curve is where you are making full use of your resources. However, if you produce at point A, so if you produce goods A at point A, that means you've got no more resources left to produce anything of good B. Alternatively, if you produce at point D, it means you can only produce the B goods and no A goods, right? So to produce at point A means I have to give up producing goods B. To produce at goods D, I've got to give up producing the goods A. So when you have to give up one thing for another thing, that is when we refer to this as the opportunity cost. Right, you can also produce combinations of goods A and B along any point along the curve here. However, we also have a point E, which is on the inside of that production possibility curve, and point E is what we call the point of inefficiency. Now, why this is inefficient is because we're not making full use of all our resources, right? And that would be known as productive inefficiency, because you're not using all of your factors of production efficiently. And then you also have point F, which is now outside the realm of your resources. So there you cannot produce. So that is known as your unproductive point. And the reason you cannot produce at point F is because you do not have enough resources available to you. But there are ways in which we can get this curve to move out to that point. Okay, so you can either come up with new production techniques or just train your workers to work better so that you are able to reach that point. So there are ways that curve can be moved. But as I said, we would like to be anywhere along this curve because we are making full use of our resources. We do not want to be at E because then this is productive inefficiency. We're not using all of our factors of production, and we cannot produce at point F because we do not have all the necessary resources to be at that point, but we can work towards reaching that point. Then we also looked at the opportunity cost, where if we produce at point A, we cannot produce any of the goods B, and if we produce at point D, we are giving up producing any goods A. So from the graph, we deduce the following. There's a point of inefficiency, which is at point E. The points of efficiency are anywhere along the curve, and your unproductive point is point F, and your opportunity cost is either point A or point D, or as I said, you can look at any combinations of doing A and B. Right, so let's look at this problem of scarcity that we have. So as a result of the scarcity issue, there are three basic economic questions that must be answered. And the three questions which you were taught in term 1, or when you just started with economics, the three questions are: what must be produced, how will it be produced, as well as for whom is production taking place? Who is going to be buying these goods and services, right? And the way in which these questions are answered is based on the economic system that is being employed. And we do have three basic economic systems that we use. There is what we call the market economy, also called sometimes the free market economy, known as capitalism. There's your centrally planned economy, known as communism. And in your free market economy, it is demand and supply controls everything. And in your centrally planned economy, that is when the government controls everything, right? They make all the decisions. But the system that is used by most people or most countries around the globe is the mixed market economy. Now, your mixed market economy is where private individuals make most of the decisions, as they do in a capitalist society or a free market economy, but the government has regulatory power, whereas that we find in a centrally planned economy, government has all of the power. So what has happened is they brought these two together, and now it's known as a mixed market economy. Okay, so you have private individuals can decide for themselves and make their own decisions, but the government has some kind of regulatory power. So therefore, the government intervenes in the market in the following ways. Now, please bear in mind, I've only listed 3 ways of government intervention here. There are some more ways of government intervention which you would have dealt with under the concept of market failure. Right. So the ways in which a government intervenes in the market is, first concept there is price ceilings, which are also known as maximum prices. So I want you to think like a house. Your ceiling is the highest point, right? Meaning that is the highest price that can be charged for a good or service. And the reason that they will implement a maximum price is to benefit the consumer. Because if they do not implement the maximum price, and they just left it up to demand and supply to determine the price, that would mean that some consumers will be locked out of the market. So to ensure that everybody has access to the good or service, the government steps in and sets a maximum price, and producers cannot sell they can't sell above that price level. They can sell below it, not a problem, but they cannot sell above that price level. So I just want to show you on a graph exactly what that's going to look like. So we're going to have quantity, and we have price, and obviously we have our demand curve, and we have our supply curve, and where the two meet that is the point of equilibrium. So that would be the equilibrium price. P1, Q1. So now, that's the price that has been set by the market. But at that price level, at P1, some of the consumers are now locked out of the market. So the government comes in and they say, no, 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 no. We need to set the price over here. So that price is dropped to P2. And this is called the price ceiling, also known as the maximum price. Now from here you can see the kinds of issues you can have. If you see here, that is where your supply is going to now move to. Make that 0. And that is where your demand is going to move to. So we see that when that price is dropped, as the law of demand says, when the price decreases, more is being demanded. And we see that the demand went from Q1 to Q2. But the law of supply, on the other hand, says that when price drop, supply will decrease. So supply decrease from Q1 to Q0. And so what do we have now? The situation you're sitting with here is that demand is greater than supply. So because your demand is greater than supply, that's going to leave you with a shortage on the market, meaning that there's going to be more available, there's going to be less available than what is being demanded. And normally when that happens, the price gets pushed up. But in this instance, we cannot push up the price because government said that is the price at which it must be sold. So we need those suppliers to be supplying to meet up with the demand. So how does one rectify this issue now? Because you can't have this situation, because this is going to lead to problems, and one of the problems you're going to have is what we call, there's going to be a black market being created here now. So what happens is government will step in and they will give subsidies to suppliers to help suppliers to push that supply to meet up with the demand. Okay, so there are ways in which they can correct that. Okay, so government sets the price below the market equilibrium to ensure that all consumers have access to the goods and or services. Then the next way in which they also intervene, this is known as a price floor, but this is also called the minimum price, which is opposite of what we've just seen now. We've just dealt with the maximum price. Now we're looking at the minimum price, right? So once again, if we look at this on a graph, supply, demand, and where the two meet is my equilibrium. So there's my P1, Q1. Right. So as we said before, your maximum price had benefited your consumers. So what's the opposite of your consumer is your producer, and your maximum price was below equilibrium. Now your minimum price is above equilibrium, right? That's your minimum price, also known as a price floor. So now the price has increased. So what do we see now? Your supply moves from Q1 to Q2, but your demand has moved from Q1 to Q0. Once again, law of demand, prices increase, demand decreases. Law of supply, price increase, supply increases, right? Still staying with that. So here now you have the situation where now demand is less than supply. So now we're sitting with the opposite of a shortage, which is a surplus now, right? So now we have a surplus of products and nobody's buying these. So what are suppliers going to do? They're going to start decreasing supply. But we cannot have that happening because, so what will happen? Government will buy up that surplus from the suppliers to ensure, because remember, the reason for minimum prices is to protect the supplier. They want to ensure that all of these people stay in the market, right? They cannot afford to lose producers or lose suppliers from the market. Okay, so in economics, you have a term called dumping, right? And dumping is when you sell your goods on a foreign market for less than what you're selling it in your own market. So this is one of the ways you can get rid of your surplus, is to take your excess products and dump them onto a foreign market, right? So price floors, also known as minimum prices, is implemented to benefit the producer. Government sets the price above the market equilibrium to ensure that some producers are able to remain in the market. So let's just have a look at these two side by side here. If we just see there, you've got your price, minimum prices there, which is above equilibrium, and you have your maximum prices here, which is below your equilibrium. Now, learners always get confused because they say, how can your minimum price be at the top and your price floor is at the top and your price ceiling is at the bottom? But remember, it is done in conjunction with where equilibrium is. Okay, so don't just think of, oh, the top one must be the ceiling and the bottom one is the floor. Always look at it in conjunction with where equilibrium is. Right, and then the last one, or one of the biggest ways in which governments also intervene, is with the minimum wages. Now, your minimum wage works exactly the same way that your minimum price would work, because remember, wages is nothing else than the price that you're paying for labor, right? Wages is the price for labor. So once again, you're going to find that your minimum wage will be above the point of equilibrium. So the minimum wage would be somewhere there. And you're again going to have a situation where the demand is smaller than. So now again you have a surplus. Because what's happening now is that there are more people who are willing to work, so there's a bigger supply of labor. So the supply of labor has increased to Q2, whereas the employers are saying, sorry, we cannot afford to employ any more people, so we're not taking on any more. So the demand for labor decreases to QO. So if you look at it, there are good things and bad things about setting a minimum wage. On the one hand, this could lead to more unemployment, right? And on the other hand, it's a good thing because now the workers are being taken care of, right? So government sets the wage level above the market equilibrium to ensure workers are not exploited and that they can earn enough to satisfy their basic needs and wants. Right, so just very quickly, if we just recap that now, we have government intervening in the market because we are working with a mixed market economy, right? Where individuals are free to open their own businesses, but there are certain government laws that governs what happens within those businesses, right? We all know about all the different acts that was implemented, and therefore they control what you are allowed to do and what you're not allowed to do. And the way they get directly involved is through price ceilings, where the price is set below market equilibrium, or the price floors, where the price is above the market equilibrium, or the minimum wages, also where the price is set above the market equilibrium. Price floors or minimum price, they are set to protect producers, whereas your price ceilings or maximum price is set to protect your consumer. And your minimum wage is there to protect the most vulnerable workers. Right. So activity 3 says, now I need you to look at 3.1 and 3.2. I need you to pay close attention to the wording of the question. 3.1 says, with the aid of a graph, whereas 3.2 says, by means of a graph. So what's the difference between the two? 3.1 says, with the aid of a graph, explain the concept price ceilings, meaning you've got to explain what a price ceiling is, but you've also got to include a graph to help your explanation. Whereas 3.2 says, by means of a graph, illustrate price floors, meaning you don't need to give an explanation, you only need to draw the graph. Okay, and sometimes the question will specifically say no graph necessary or no need to draw a graph, etc. But this is how you can also see by looking at the wording of the question. With the aid of a graph means graph plus explanation. So if it's for 8 marks, you will then normally be given 4 marks for the graph and 4 marks for the explanation. And this is probably so much easier because if you can draw your graph and you get 4 out of 4 for your graph, you should get 4 out of 4 for your explanation, because all you're doing is you're explaining exactly what is on the graph. Okay, let's just look at that quickly. You see there, you've drawn the graph. Okay, so I said there, also known as maximum price. The price is set below the equilibrium price. So there's my equilibrium. There I've drawn the price ceiling. This is done to ensure that all consumers have access to the good or service, and therefore this benefits the consumer. And there they've shown you how they will allocate the 4 marks for your graph. So you'll be given 1 for saying price and quantity. For writing price and quantity here, that's 1 mark, right? And then for indicating your supply curve, indicating the demand curve, and for indicating where the price ceiling is, that is another mark. That should say price ceiling, not price floor. Then it says, by means of a graph, illustrate price floors for a full 8 marks. And then if we look at that, you just basically have to draw the graph only, right? Just draw the graph, and then once again here, now you get 1 mark for price, 1 mark for quantity, 1 for supply, 1 for demand, right? 1 or 2 marks for indicating the price floor. 1 mark for writing that there's a surplus, and another mark for indicating where the equilibrium point is, to get the total of 8 marks. Right, then 3.3, study the graph below and answer the questions that follow. So here we've got a drawing of the minimum wage, right? So there they've used wage rate, quantity, and there we see the minimum wage. It went from W to W1, and then we see the shift in quantity also, right? So the quantity went from the quantity demanded went from Q to Q1, and the quantity supplied went from Q to Q2. Right. So 3.3.1 says, what is the original wage level? Meaning, where was this wage set prior to the minimum wage being implemented? So we see there is the level for the minimum wage, and before that we're looking at what did the market say should the wage be. So that would be where demand meets supply. So that would be at point W. Who sets the minimum wage level? We started this by saying these are all ways in which the government intervenes. So the minimum wage level is set by the government. What is the current minimum wage level in South Africa? Now, grade 10s, these are things that you are expected to be aware of. You're not always taught this in the classroom, right? So you should have some idea of what the current minimum wage level is in South Africa. And it's about 23 Rand and 19 cents at the moment. Why is it set above the equilibrium? Why is it not set at this point, right? So it's not set here because that is too low, right? If people have to earn this amount of money, they're not going to be able to satisfy their basic needs and wants. So they want to make sure that people are able to earn a living wage or at least enough money to satisfy their basic needs and wants. Now, 3.3.5. In your opinion, is this a good policy to implement? Now, when learners see a question like that, they normally just leave it open. The question says, in your opinion. I can't tell you your opinion is wrong, right? Unless your explanation is very, very far off the mark. But most of the time, people have an opinion. As I said, sometimes this can be a good thing, and sometimes it can be a bad thing. But you have to take a stand and decide which one do you go with? Do you go with the fact that it's a good thing, and then you will explain why you say what is good about the minimum wage, and then you will also, if you want to go on the other side, you can also explain why you think it is not a good thing to have this kind of policy. Right. That brings us now to the various market structures that operates within the economy. And here we are faced with what we call perfect markets as well as imperfect markets. Now, important here you need to look at is that with your perfect markets, your other three, the monopoly, the oligopoly, and monopolistic competition, all three of these together, they make up your imperfect market, right? So you've got, what I've done here is I've just listed or just summarized the differences between perfect markets, and then these three together, they form your imperfect markets. But it's important that you understand that within the imperfect market, we have these three that work alongside one another. Okay. This column here is we're going to look at the characteristics, and the way in which these questions are normally set is like you've got to tabulate the difference in characteristics between, and then they will say to you, discuss the number of firms, barriers to entry, information, and how they differ between a perfect market and an imperfect market, or how does it differ between a perfect market and an oligopoly, for example. Okay, so let's just have a quick look at what that has to say there. So, also bear in mind that any of these you can be asked to write an essay on just the characteristics of the perfect market, or characteristics of a monopoly, characteristics of an oligopoly, or the characteristics of monopolistic competition. And obviously, as you can see, if you're just going to write this is not going to give you the amount of marks. So you need to listen to the discussion to see how you can flesh out these points, right? These are what I call my study notes, right? So these are my keywords, and from this, I can now broaden out or flesh out what I want to say. Right. So when we look at the perfect market and we look at the number of firms, it says there that in a perfect market, there are many firms. Now you have to sit and think to yourself, what does it mean when there are many businesses or many firms operating in the same market. Right? There's more than one business operating in the market. So what does that mean? That means I have competitors, right? So because I have competitors, that means that many sellers in the market means there's a number of competitors within that market. And because competition exists, I've got to bring my A game, right? You've got to be on top of your game. You've got to constantly do research into your products to make sure your product is of the best, right? You also have to probably consider the pricing of your product and all of those things. So with many firms being in the market, this paves the way for lots of competition to be available within the market. Right, so for the business it means many competitors, but for the consumer it means they have a variety of places where they can go and shop at, right? They don't have to just go to one person because there are many of them around. Right, if you look at the nature of the product within the perfect market is homogeneous. Now you need to explain to the person marking this. They don't know what the term homogeneous means. So now you explain it a bit further. Yes, the products in the perfect market are homogeneous. This means then that they are identical. The products are all exactly the same, right? They look the same, they have the same purpose, so therefore they are homogeneous. If you take, for example, fruit and vegetables, right? A carrot is a carrot. Okay, and they're all going to give you the same vitamins. Right, barriers to entry. Now, within a perfect market, there are no barriers to entry. So, if you think of the term barriers, a barrier is something that stops you, right? So now we're saying there are no barriers to entry, meaning nothing stops any producer or any seller from entering in the market, from becoming part of that market. Okay, and the fact that there are no barriers to entry, this opens up for several people to become part of the market. Right, the information within the perfect market is perfect. Now, what do we mean when we say the information is perfect? That means that everybody, your producers, as well as your consumers, everybody is fully aware of all of the market conditions that are prevailing at the moment. They know where they can buy what and at what price they can get it, right? And that brings us to the next point on price setting. So in a perfect market, the seller is a price taker. Now the name says it all. He's a price taker. He takes the price. He doesn't set the price. He has to take the price that has been set by somebody else. Now, in a perfect market, it isn't a person that sets the price. The price is set by the market forces. And your market forces are demand and supply. So wherever demand and supply meets, that would then be the price which the perfect competitor has to then take. So therefore, he's a price taker. Right, we're moving over now. So just to sum up very quickly, a perfect competitor, there are many sellers within the market, meaning there's lots of competition, and everybody sells the same product. Their products are homogeneous, meaning the product is identical. So there are no barriers to entry. So any business can enter or leave at any time. And the information is perfect, meaning that all the role players, the consumers as well as the producers, have full knowledge of what the prevailing market conditions are. And they are price takers, meaning the prices are not set by the businesses, it is set by the forces of demand and supply. Right, and an example of a perfect market would be your Johannesburg Securities Exchange, because a share is a share. A share is a piece of paper with your name on and what type of shares you own. The only thing that differs is the type of share you own, but the share certificate doesn't change. Right. We're moving on to the next one, which is the monopoly, the first one within the imperfect market. Now, your monopoly, there is only one firm, right? Or one business within the market. So because there is only one, this means they have absolutely no competitors. There's nobody that competes with them, right? The product that they sell, the nature of the product, it is unique, meaning it cannot be substituted. There are no substitutes available, right? You cannot substitute this product. It is unique. The barriers to entry, this market is completely blocked, right? It is very, very difficult for competitors to enter into this market. And various reasons for why it's blocked, right? There could be something like patents, right? For example, in the pharmaceutical industry, if you're producing a drug to cure something, you have 10 years. I think their patents last for 10 years. So within the first 10 years, nobody else can now copy what you are doing. But after that 10 years have elapsed, other people can come up with a generic of that original drug that you have developed. Okay, so in that way, they keep other people out of the market, right? So patents is one example of keeping people out. The information is imperfect, meaning not everybody has knowledge about the market, right? And this is one of the things how people can remain a monopoly, because they will keep some information to themselves and not let that out to others. And then because remember, they're the only business in the market, so they are a price maker. They can decide what they want to charge. They make up their mind, but bearing in mind, yes, they can decide what they want to charge, but at the same time, they've also got to remember consumers have limited income, so they can't make the price too exorbitant because then nobody's going to buy their product. So they need to set their price bearing in mind what can the consumer afford, how much is it that the consumer is willing to give. And the example I've used here is Eskom, because that's sort of the biggest monopoly that everybody knows in South Africa. But Eskom cannot just set its prices at will. Right? There is a body, a government body that controls what Eskom does when it comes to the setting of the prices that they do. And this body is known as NERSA, N-E-R-S-A. Now, NERSA is the National Energy Regulator of South Africa. So before Eskom can just say, oh, we're putting up the price by 10% or 20%, they first have to pass it by NERSA before that is made. So just another way of which government sort of controls things within the market. Right. We move over to the oligopoly. Another example within the imperfect market. So within an oligopoly now, we have a few businesses, right? So when I say a few businesses, students always say, how many? What's the number? A few, 2 to 5 businesses, right? Very little sellers within this market, very little people who offer this product or service, right? And the products, the nature of the product within an oligopoly can be homogeneous, meaning they are identical, or it can be differentiated, meaning another term for differentiated is heterogeneous, meaning there's something that that differs from what the others are offering. The barriers to entry here, entry into the market is restricted. Right? And another example can once again be licensing agreements, right? That restricts people from getting into this market. Information, once again, is imperfect as it was within a monopoly. Not everybody knows anything. And the one thing within an oligopoly market that we find is the concept of technical superiority. So you will find with car manufacturers, remember there are not many people who there's a lot of people who sell cars, but we don't have lots of people making cars, right? So the way in which they sort of get the better of their competitors is by means of technical superiority, right? There's something that their car can do that other cars cannot do, and they don't share that information freely. And they are also price makers, right? They decide on their own price. And within an oligopoly, this is the only market structure where we find the concept of collusion happening, right? Now, collusion normally comes into play when setting of prices. This is where, because remember I said there's only a few businesses within this market structure. So then it's easy for them to get together, and then they will collude on how much they're going to charge consumers. And obviously at the end of the day, it's about pulling the wool over the consumer's eyes, and they making the profit, right? And please bear in mind, collusion is illegal in South Africa, right? You're not allowed to collude. So if you are, if they do discover that this has happened, you will be fined. And that has just happened with a few years ago, they discovered the Greenpoint Stadium in Cape Town, and all these stadiums that were built for the FIFA World Cup, how these construction companies had colluded. And now they were fined, and these fines are paid now to the municipalities where these stadiums were erected. Because, so in Cape Town, I know it's like, it's a huge amount. I can't remember exactly how much million, but we're looking forward to getting quite a bit of millions from the construction companies that were found guilty of collusion. And then the examples here are your cell phone service providers. I've also given as an example. And your cell phone service providers, obviously like Cell C, Vodacom, etc. Right. Then our last example of an imperfect competition, imperfect market structure is monopolistic competition. Now, if you listen to the name, monopolistic competition, we know a monopoly means only one business, right? And we said in that market structure, there is no competition. Now you come with a market structure known as monopolistic competition. How does that even make sense? One, but with competition. Okay, so here we go. So the number of firms within the monopolistic competition market structure, there are many. So we see here with a perfect market, also many, right? So in that respect, they are exactly the same. The nature of the product, this is where they differ, right? So in a perfect market, it's homogeneous, but for monopolistic competitor, the goods are differentiated. Right? Meaning there is something, they offer exactly the same, but there is a difference to it. Once again, barriers to entry, none, exactly the same in the perfect market. And the information is imperfect, because obviously here you're dealing with, if you look at my example, I use this food outlets, fast food outlets. So obviously, KFC don't want others to know what their herbs and spices are that they use on their chicken. And also, they are price makers within a monopolistic competition, whereas perfect competitors, they are price takers. So we see there's a lot of similarities between your perfect market and monopolistic competition, but there's also similarities between your monopoly and your monopolistic competition. Right? And I said here, the example here are the fast food outlets. So if you just think of your differentiation of your products, your McDonald's fries are very different to your Steers fries, for example. Okay, so once again, with many sellers in the market, lots of competition, differentiated products, so consumers have a choice of which ones they like. And like I said, I use Steers and McDonald's. Some people love McDonald's fries, others prefer Steers fries, right? There are no barriers to entry, so there's always a space for new people to enter the market, and we've seen that happening We've seen the American fast foods that have moved in. McDonald's was here for a while, and finally then Burger King also entered into the market. We've seen Dunkin' Donuts come and gone. We've now seen Starbucks coming in as well. Right? The information being imperfect, meaning not everybody has full information about the market conditions, and then they are price makers, meaning they determine their price. They decide what their price will be. And as I said, the example that I use is your fast food outlets. Right. We're coming to the final activity for this session. So just before we move on to the activity, we're going to take a short break and just let everything we've discussed just sink in before we move on to the activity.